Hey, what's up everyone? Welcome back to my channel, where I help you achieve your financial goals with smart and simple strategies. If you're new here, make sure to hit the subscribe button and the bell icon so you don't miss any of my future videos. Today, I have a special treat for you. I'm going to reveal some of the most powerful and proven investment tips from none other than Warren Buffett, the billionaire investor and the CEO of Berkshire Hathaway. Warren Buffett is widely regarded as one of the greatest investors of all time, and he has a track record of beating the market for decades. He's also known for his witty and wise advice, which can help anyone become a better investor. So, are you ready to unlock financial success with Warren Buffett's non-boring million-dollar investment tips? Let's get started. Tip 1. Invest in what you know and understand. One of the most important principles that Warren Buffett follows is to invest in what he knows and understands. He doesn't invest in companies or industries that he doesn't have a clear idea of how they make money, what their competitive advantages are, and what their future prospects are. He says, never invest in a business you cannot understand. This means that he avoids investing in things that are too complicated, too risky, or too trendy. For example, he has stayed away from cryptocurrencies, biotechnology, and social media because he doesn't feel confident about their long-term viability and profitability. Instead, he focuses on businesses that have simple and durable models, such as consumer goods, insurance, and utilities. The lesson for us is to do our homework before we invest in anything. We should only invest in companies that we can explain in a few sentences, that have a strong brand, a loyal customer base, and a consistent cash flow. We should also avoid chasing the latest fads or following the crowd, because they often lead to losses or disappointment. Tip 2. Look for companies with intrinsic value. Another key factor that Warren Buffett looks for when he invests in a company is its intrinsic value. Intrinsic value is the true worth of a business, based on its assets, earnings, growth potential, and competitive edge. It's not the same as the market price, which can fluctuate due to supply and demand, emotions, and expectations. Warren Buffett tries to find companies that have a high intrinsic value but are selling at a low market price. This means that they are undervalued, or in other words, they are on sale. He says, whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. This means that he is not afraid to buy stocks when they are cheap, even if they are unpopular or out of favor. He sees this as an opportunity to get a bargain and to benefit from the eventual rise in the market price. He also avoids buying stocks when they are expensive, even if they are popular or in high demand. He sees this as a risk of overpaying and of suffering from the eventual fall in the market price. The lesson for us is to look for companies that have a high intrinsic value, but are selling at a low market price. We can estimate the intrinsic value of a company by using various methods, such as discounted cash flow analysis, earnings multiples, or book value. We can also compare the market price of a company to its peers, its industry, or its historical average. We should aim to buy stocks when they are trading below their intrinsic value, and sell them when they are trading above their intrinsic value. Tip 3. Be patient and long-term oriented. One of the most remarkable traits that Warren Buffett has is his patience and long-term orientation. He doesn't invest in companies for a quick profit or a short-term gain. He invests in companies for the long haul, and he holds them for years or even decades. He says, our favorite holding period is forever. This means that he doesn't care about the daily fluctuations of the stock market or the quarterly earnings reports of the companies. He cares about the long-term performance and growth of the businesses and the compounding effect of their returns. He also doesn't sell his stocks unless there is a fundamental change in the business or a better opportunity elsewhere. The lesson for us is to be patient and long-term oriented when we invest. We should not let our emotions or impulses dictate our decisions or chase the short-term trends or news. We should focus on the long-term potential and quality of the businesses and the power of compounding. We should also not sell our stocks unless there is a good reason to do so, or a better alternative to invest in. Tip 4. Diversify, but not too much. Another smart strategy that Warren Buffett uses is to diversify his portfolio, but not too much. He doesn't invest in just one or two companies, or in just one or two industries. He invests in a variety of companies across different sectors, geographies, and sizes. He says, diversification is protection against ignorance. It makes little sense if you know what you are doing. This means that he spreads his risk across different types of investments so that he is not exposed to a single failure or a single downturn. He also takes advantage of the different opportunities and returns that different investments offer. He says, wide diversification is only required when investors do not understand what they are doing. However, he doesn't diversify too much or to the point of diluting his returns. He doesn't invest in hundreds or thousands of companies or in every industry or market. He invests in a handful of companies that he has researched thoroughly and that he has high conviction in. He says, the idea of excessive diversification is madness. The lesson for us is to diversify our portfolio, but not too much. We should invest in a variety of companies across different sectors, geographies, and diseases, but only in those that we have a good understanding of and a strong belief in. We should avoid investing in too many companies or in those that we have no clue about or no interest in. Tip 5. Be fearful when others are greedy, and greedy when others are fearful. The last but not the least tip that Warren Buffett follows is to be fearful when others are greedy, and greedy when others are fearful. He doesn't follow the herd mentality or the market sentiment when he invests. He does the opposite of what most people do, and he goes against the grain. He says, we simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. This means that he doesn't buy stocks when they are rising, and everyone is optimistic and euphoric. He buys stocks when they are falling, and everyone is pessimistic and fearful. He sees this as a chance to buy low and to profit from the eventual recovery. He also doesn't sell stocks when they are dropping, and everyone is panicking and selling. He sells stocks when they are soaring, and everyone is complacent and buying. He sees this as a chance to sell high and to avoid the eventual correction. The lesson for us is to be fearful when others are greedy, and greedy when others are fearful. We should not let the market mood or the crowd behavior influence our decisions or sway our emotions. We should do the opposite of what most people do, and we should go against the tide. We should buy stocks when they are cheap and sell them when they are expensive. Conclusion. So there you have it. These are some of the best investment tips from Warren Buffett, the legendary investor and the CEO of Berkshire Hathaway. I hope you found them useful and insightful, and that you can apply them to your own investing journey. If you enjoyed this video, please give it a thumbs up and share it with your friends and family. And if you want to learn more about investing, personal finance, and wealth creation, make sure to subscribe to my channel and hit the bell icon so you don't miss any of my future videos. Thank you so much for watching, and I'll see you in the next one. Cheers!